we've got to talk about Powell. Because while Donald Trump just reiterated on social that is the consensus of almost everybody that the Federal Reserve should cut rates sooner rather than later, we heard Powell this week give us his framework for what's going on. We've got to break this down because this is absolutely insane. So in the 2010s, we had a principle called flexible average inflation targeting. This was basically the Federal Reserve saying, look, we'll tolerate inflation undershooting our 2% goal for a while because it could be higher in the future. And so we'll just keep rates lower for longer and we'll tolerate lower inflation without injecting too much money into the economy. Mind you, we were injecting insane amounts of money. And we'll just tolerate 1.7% inflation because we'll just average it out to 2% over the long run. Okay, so that was a way for the Fed to actually keep a steady flow of money pumped into the economy, but not overdoing the amount of money they were flooding into the economy. That obviously changed during COVID, and we way over pumped money into the economy because of the pandemic and the shutdown of the economy and the 30 days to slow the spread. Fine. Now inflation is running higher, and what we heard about a year and a half ago was Jerome Powell tell us, oh, flexible average inflation targeting? Oh yeah, we only use that as a tool to justify why inflation was running lower in the 2010s, but that was a different time, and now we just want to focus on getting back to 2% inflation, and so flexible average inflation targeting is dead. So first, when it was convenient, it was, oh yeah, we're going to use FATE, flexible average inflation targeting. Then, when it was inconvenient, we're not going to use flexible average inflation targeting. What did we get this week, boys and girls? Oh, yeah, we're going to go back to flexible average inflation targeting. The credibility here is getting a little shaky. And when I say getting, I mean maybe it already is. But what does this practically mean for us, right? This is what's important. Why does it matter that the Fed would consider flexible average inflation targeting again now? Well, what it means is that the Fed might be willing to tolerate slightly higher inflation now because it'll average to 2%.
Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target. Given the downside risks to employment and inflation from proximity to the lower bound and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time.
Okay, interesting. So what does that mean? Well, it actually is a good thing. It potentially opens the door to Powell being willing to lower rates sooner rather than later. Because if the Fed is willing to tolerate inflation slightly above 2% for some time, then it could actually imply that the Fed is willing to loosen sooner if we start seeing shakier reactions in the labor market, which might be coming. We're already seeing a disaster in the 27 weeks unemployed number rising, which is usually an indicator of a recession. That's the 6 months or more unemployed level. We're seeing plenty of softening in jolts and quits, which are indicators of a potential recession coming, or at least indicators of a weaker job market. And hopefully those numbers stabilize. Too soon to tell right now. It'll probably take another 3 months to tell. But what I'm seeing, and this is, I think, the part that matters to you, is I'm actually starting to see a Powell that's warming up to the idea of cutting rates. Because not only is he sort of reviving flexible average inflation targeting, but he's also telling us that in past situations, we ended up cutting rates by 500 basis points when our economy is in recession.
While our policy rate is currently well above the lower bound, in recent decades, we have cut the rate by about 500 basis points when the economy is in recession.
Now, this is really interesting because you kind of have two messages that come from this Fed meeting where the Fed just discussed, hey, we're willing to tolerate slightly higher inflation. Oh, by the way, when we've had to cut rates in the past substantially, we did so by 500 basis points. Now, let me translate that to English. Right now, we've cut from about a high end of 5.5% to 4.5%. Cutting 500 basis points isn't possible anymore. We can only cut 4.5%, but we already cut by 1%. So basically, go from that high, 5.5%. Assume recession hits. The Fed just told you at the high end, they will cut rates to 0.5%. So high end 5.5 minus 5%, 0.5. So we'll be somewhere between 0 and half a percentage point of rates if we go back to recession. And the Fed would be willing to tolerate slightly higher inflation, essentially to bail out the labor market. So in other words, if you're waiting for rates to come down, this is, you don't want to cheer for this because it causes a lot of pain, but let's just be clear. If you're like, when are rates gonna come down? Because I want to refinance my house. When a bunch of people lose their jobs. So in other words, when everybody else is suffering, the rich who are able to go refinance, who have access to bank debt, who will qualify for bank debt, and who haven't lost their jobs, they'll be able to go tee up a bunch of cheap debt again. And Jay Powell basically just rolled out the red carpet for massive money printing again. So think about that. The red carpet is out for massive money printing again because Jay Powell is now willing to go back to flexible average inflation targeting, which suggests he's more interested in being concerned about the labor market, less interested in inflation at 2.5%, being willing to accept that, and teeing up 500 basis points of cuts, basically 5% of rate cuts to try to protect the economy, which is potentially exactly what Donald Trump wants. Who knows? Maybe Donald Trump is teeing up just enough unemployment to cause Jay Powell to fold and bring rates right back down to 0. Or maybe Jay Powell just doesn't want to lose his own job, even though Donald Trump says, I could fire him if I want to, but I'm not going to. Of course, there are whole legal precedents around whether or not this could actually happen. The technical legal answer is no, Jay Powell can't be fired. But let's be clear, Donald Trump has ways of doing things and then asking for forgiveness later. So I have a feeling if Donald Trump really wanted to get rid of Jay Powell, it would happen. By the way, there are also some headlines circulating about the Federal Reserve cutting, a certain percentage of their staff, 10% over the next few years. This isn't like immediate sort of Fed laying off. It's just a reduction in hiring and then attrition. People who sort of retire or move on over time. The Fed's just not going to replace them. The Fed has over 2,000 different economists, and somehow we still missed that, inflation would go up substantially more after all of the money printing we did post-COVID. But hey, whatever. So anyway, that gives you a little bit of a breakdown of what the heck the Fed is thinking. Now, also worth noting that University of Michigan survey that we got on Friday had a little note in it. Even though the actual University of Michigan Consumer Sentiment Report was bad, it was, one of the worst we'd seen in a very long time, with near-term consumer inflation expectations crossing the 7 handle, crazy. There was a little note that consumers showed some signs of improvement after the May 12th announcement, where they still had 2 survey days left, the 13th and the 14th, to finish out their survey. So we could see better consumer sentiment data going forward now that we had that May 12th China-US deal, which is exciting. That said, you still have bankers like Jamie Dimon, who I do respect substantially. We'll see how my opinions of JPM play out. I used to have a lot of respect for him, but more on that in the future. But Jamie Dimon right now suggests about a 50% chance of recession, and he basically says, no idea, but just don't take recession off the table at the moment, which sort of lines up with Jerome Powell's skittishness around the labor markets. Hey, quick reminder, if you want to earn a 5% yield plus all of the upside in my real estate startup, we are offering a non-accredited investor round where we will pay you a 5% yield plus you get all of the upside in the stock when your stock converts in the future. It gives you an opportunity to diversify away from rich stock market valuations, diversify away from most tariff risk, diversify away from the craziness of the treasuries market, especially with these Moody's downgrades. You diversify into fixer-upper real estate, which is what I believe I do best. This is my baby. I call it my little Berkshire Hathaway. Now, maybe I'm biased, but I've got over $5 million of my own money invested into this business, and I'm so excited for what I think we're going to be able to do with this business over not just the next years, but the next decades. So if you want to invest in my real estate startup, go to househack.com and know that I will do everything for this business in my power to make sure we can do the absolute best that we can. Make sure to read the solicitations and disclosures on the Househack website, because there is risk with every investment.